Boy, a lot of stuff happening this week and, of course, next week as well. But, the big story is the backdrop of what is really happening with the GDP report. With so many folks, economists, and all due respect, were guaranteeing that we were going to have a recession. Yep. Well, a recession is back-to-back negative quarters of GDP. Well, guess what? We just got a report from the Atlanta Fed, which is far from negative.
Yes, the Atlanta Fed, they have what they call a nowcast. And so based upon most recent information that they have, and this one specifically was driven by our industrial production and our retail sales numbers. And those were much better than expected. And so as a result, they're actually forecasting that we're going to have one of the strongest quarters that we have seen since the COVID recovery. Now, I'm a little skeptical about their model.
And Atlanta Fed does get ahead of themselves from time to time, but go ahead.
That's right, yeah. And especially when you get these early reads and you typically see this drifting lower of their real-time estimate as the quarter goes on. Although our view here on our investment committee is that we're not really out of the woods quite yet, right? We had a good month for retail sales and industrial production, but it wasn't very broad-based. When I dug into the industrial production numbers, most of that was driven by air conditioner use, right? So utilities really ramped up because of the hot weather. Right. And then also autos. Autos jumped 5.4%, but every other manufacturing sector was basically flatlining it.
And we're seeing a lot of those cross currents right now. So we're seeing that number, which is positive, and that could bleed into the fourth quarter. So it's really almost impossible now to have negative GDP this year because you need two back-to-back quarters. And so we'll have to see if it really hits the brakes. But the reason why I bring this up, of course, is the all-important Fed meetings. And, of course, they get together in Jackson Hole, Wyoming. I don't know that we're going to hear much out of them, but we're certainly going to watch what happens.
Yeah, a lot of people are going to find the Jackson Hole meeting, which is the 25th, where on that Friday, around, I think, 8 a.m. is when Chair Powell is scheduled to speak. Last year, when he spoke, he basically used very few words, but they were very powerful, and the markets did not like what he had to say. He basically said, we're going to keep hiking until we break the back of inflation. He was channeling his inner Paul Volcker. This time, he might be a little bit more circumspect. He might not want to make as many waves because they don't really have a good reason to hike, but they don't have a good reason to cut. So maybe he's just going to try to make as few waves as possible.
But, if he does not want to be Paul Volcker, a lot of people won't remember this, but back in the day, back when we had the inflation issues back in the early 1980s, Paul Volcker hit the accelerator, he hit the brake, he hit the accelerator, he hit the brake, and that caused a problem.
It did. Yeah, that's a very good point, is he was a little inconsistent, and I think that what Chair Powell really wants to do is learn from that. The Fed as an institution, they make mistakes, they try to learn from those mistakes, but then they create brand new mistakes. Yeah. And so I think what they might try to err on the side of is holding rates where they are steady for longer than what they absolutely need to.
And so higher rates for longer really means that you have to put that into your valuation models. And so, for example, that has pressure on other categories, fixed income, real estate, and equities all work off of that. And the 10-year Treasury went up higher this week, and of course higher rates puts pressure downward on prices.
It does, exactly. And that's a really nice way to put it, is that when you have those higher rates, you get lower prices. It's just kind of the mechanical way that it works. And with the 10-year Treasury, one of the other factors here has been the fact that the federal government has a massive debt that it needs to finance, and they are doing some refinancing. Yeah. The market doesn't care for it much. It's almost as though the deficit is at a level that would be consistent with us being in a recession, not a great expansion.
Right, and so we're going to have to watch that because we're getting these cross currents. So higher rates for longer means, for example, higher mortgage rates. We saw this past week that mortgage rates were the highest that we have seen in 20 years, folks. And so that is how it hits your pocketbook. And that's why it is so important that you look at your portfolio and make sure you're aligned with what is going on in the world today. Do you have the right mix of stocks and bonds and real estate? Is your financial plan set up for higher rates? Because we had zero interest rates for so long.